Hello everyone, welcome back to my financial accounting series. Today, we're diving into the exciting world of transaction analysis and basic journal entries. Stick with me for the next 10 minutes and you'll learn how every transaction impacts the accounting equation and how to prepare those all-important double entries. Alright, let's get started with the basics. Recalling the fundamental accounting equation is assets equal liabilities plus equity. First up, let's talk about the dual effects of transactions. Dual effect means that a transaction impacts at least two accounts to maintain the balance in the accounting equation. This is crucial because, for example, if only the amount of assets increases, the left-hand side of the seesaw would tip over, causing an imbalance. Now, when I say two accounts, I'm not just referring to the three main categories: assets, liabilities, and equity. I'm also talking about the numerous sub-accounts within these categories. For example, check out this chart of accounts from a demo company. Under current assets, we've got cash on hand, trade debtors, and prepayments. Under office equipment, there's office equipment, computer equipment, and motor vehicles. And under current liabilities, we have trade creditors, tax payables, and bank loans. If buying a MacBook with cash, a company total assets don't change because the increase in computer equipment is offset by a decrease in cash. Now, let's have a very quick look on classifying assets and liabilities as current or non-current. Current assets, expected to be converted into cash or used up within a year. Think cash, accounts receivable, and inventory. Non-current assets, not convertible to cash in 1 year or useful life of over 1 year, like plant and building, equipment, and long-term investments like 3-year government bonds. Similarly, current liabilities, obligations due within a year, like unpaid electricity bills, accounts payable, and tax payables. Non-current liabilities, obligations due after a year, like long-term bank loans and corporate bonds. Now, we move on to step-by-step transaction analysis to see how to record a transaction. First, identify each account affected by a transaction. Second, classify the direction for each account being affected. The direction here means increase or decrease the balance of that account. Third, verify the accounting equation remained balanced or not. That is, the change in assets equals the sum of change in liabilities plus equity. Let's walk through a practical example to better understand the impact of a financial transaction. Imagine a company takes out a 3-month loan of $3,000 from a bank. First, identify each account affected by this transaction. Cash is drawn down from the bank. It certainly is an asset. Bank loan is a liability that the company will need to repay by cash in 3 months. Next, classify the direction for each account affected. Cash increases by plus $3,000 upon the loan drawdown. This means that the company receives $3,000 in cash from the bank. Bank loan increases by $3,000 as the company now owes this amount to the bank. Finally, verify the accounting equation. In this case, the increase in the asset side, cash, by $3,000 is balanced by the increase in the liability side, bank loan, by $3,000. Therefore, the equation remains balanced. Now, let's take a big step forward. Learning debits and credits. In double entry bookkeeping, every transaction must have equal amount of debits and credits to keep the accounting equation balanced. They don't mean good or bad, they are just ways to record changes in various accounts. Debits are recorded on the left side of an account. For balance sheet accounts, it is used to record the inflow of assets. Credits are recorded on the right side of an account. For balance sheet accounts, it is used to record the inflow of liabilities or equity. For assets, debits represents an increase while credits represents a decrease. For liabilities and equity, as they are on another side to assets, the direction of debits and credits are opposed to assets. So, debits represents a decrease while credits represents an increase for both liabilities and equity. You might be wondering about income statement accounts. Indeed, they work the same way, fall under equity. It is because income and expenses are temporary accounts and eventually become part of equity as retained earnings upon closing the account of a year. Let's take a moment for a concept check on permanent versus temporary accounts. Permanent accounts. These accounts are found on the balance sheet and are sub-accounts under assets, liabilities, or equity. They carry forward from one accounting period to the next, accumulating their balances since the incorporation of the company. Temporary accounts. These accounts are found on income statement, including all revenue and expense accounts. Throughout a financial year, these accounts accumulate the company's revenues and expenses. Then, upon closing of the account for each financial year, the amounts in these accounts are transferred to retained earnings. They are then reset to zero at the beginning of the next accounting period. In my first lesson, I demonstrated how it works using an example. If you haven't watched it yet, I encourage you to take a quick look. It will provide you with valuable insights into how these accounts function and interact with each other. Now, imagine retained earnings like your personal savings. What increases your savings? Your income. What decreases it? Your expenses. So, income and expenses work the same way, fall under equity. For income, credits represents an increase while debits represents a decrease. For expenses, debits represents an increase while credits represents a decrease. And remind that net profit loss is not an account. Before we move on to some examples, if you found this video helpful, please give it a thumbs up and subscribe to our channel for more accounting tips. Let's see how this works with some examples involving income statement accounts. Example 1. Tom Limited received $5,000 in cash for its football training class held in May 2024. First, identify each account affected by this transaction. Cash being received is an asset course fee, is the income earned from the training service provided to customers, so it is revenue. Next, classify the direction for each account affected. Both cash and revenue increases by plus $5,000. Double entries is therefore debit cash plus $5,000. Credit revenues plus $5,000. Example 2. By the end of May, Tom Limited paid $2,000 in salaries to its part-time football coach. Paying cash means decreases by $2,000 and salaries expense. For May, increases by $2,000. Double entries is therefore debit salaries expense plus $2,000. Credits, cash, $2,000. Here's a practical tip to keep in mind when dealing with transactions involving cash. Start by determining the direction of the cash balance, always asking yourself, is cash being received or paid out? This step is usually the easiest to start with. Here's a table summarizes the natural balance of accounts. It's another way to help students to memorize the directions. Debits on the left increase assets and expenses. Credits on the right increase liabilities, equity, and income, and vice versa. Before we conclude today's lesson, let's take a moment to recap the key points we covered. First, in financial accounting, every transaction has a dual effect, meaning it impacts at least two accounts to keep the accounting equation balanced. Second, transaction analysis. Step 1, we identify the accounts that are affected by the transaction. Step 2, we determine the direction of the effect on each account, whether it increases or decreases. Finally, we double-check that the amounts of debits equal the amounts of credits to ensure accounting equation remains balanced. Finally, debits and credits. Learn the diagram showing the directions of debits and credits on assets, liabilities, equity, income, and expenses. Next lesson, we will cover one of key principles in financial accounting, accrual basis accounting, then move on to adjusting entries for closing at each period end. Thanks for watching. If you have any questions about today's video or financial accounting, drop them in the comments below. I'm here to help. If you found this video helpful, please like and share. Don't forget to subscribe to stay updated with more accounting tips and tutorials. See you next week.